Hi, I'm Jerry Michael, president of Smartleaf. In our last video, we rebalanced an entire book of business in 3 minutes, with every account receiving high levels of customization and tax management. Today, we're going to look under the hood at the individual settings and trades for one of the accounts we rebalanced. Let's take a look at the portfolio of David Niederman. If I click on his account, we see a summary table, which is explaining some of the things going on. We'll get back to this table in a moment. If we scroll down, we can see the individual trades for David's account. You can see there's some Chevron Texaco that's being sold. If I click on the little plus sign, you can see there's 4 lots of Chevron Texaco, and the system's recommending selling 3 of them. If I click on one of the tax lots, it will give me the reasons for recommending the sale of this particular tax lot. We could, if we wanted to, modify any of these trades, but we won't do that now. Instead, let's go back up to this table. It provides summary statistics for 3 different portfolios. There's the current portfolio, what David has today. There is what would happen if you traded straight to David's target. Exactly. If his target says 2% IBM, we'll get 2% IBM. But it's the middle portfolio that's interesting, the recommended portfolio. It's the portfolio you asked for, the portfolio that follows all of your preferences and parameters. And we can look at some comparative statistics for these 3 portfolios. First, we can look at drift to target, which we measure using tracking error. If you were to trade straight to target, there would be no drift. If you do nothing, the current portfolio has drift of about 1.12% expected tracking error. The recommended portfolio, which follows your parameters, reduces drift by about 2/3. Why does it stop at 2/3? Well, we can get a sense by looking at total trading costs. If you don't trade at all, there are no costs. If you were to trade David's portfolio all the way to target, it would cost David over $24,000. But if you stop 2/3 of the way there, it will cost David only $267. This isn't quite the 80-20 rule. It's 2/3 of the way there at 1% of the cost rule, which is pretty good. This is an example of tax sensitivity. It did it because David asked his portfolio to be tax sensitive. How does the system know that? Well, that's contained in David's profile, which we can look at by clicking here. There are a lot of options. We can set cash management preferences, tax management preferences. We'll take a look at social screens. I click on this little edit button. We can see there's a number of options, and David has selected 2 of them. He has requested that his portfolio not purchase gambling or weapons companies. The good news is clicking on these 2 boxes is all that it takes. Actually executing David's customization requests is done automatically. That's true for ESG constraints. It's true for all customization and tax management. And that's key. Customization and tax management are not implemented through on-the-fly manual adjustments to trades. Once you set up the parameters, they're automatically taken into account in every analysis. No additional work is required for implementation. This automation cuts the incremental cost of customization and tax management to 0. And this makes it economically feasible for you to offer all of your clients high levels of customization and tax management. That's a good thing. It's good for your clients, and it's good to do good for your clients. But it's even better to do good for your clients and show them that you're doing good. We offer a number of reports that let you do just that. We'll show you these reports in our next video.